Hey everyone, listen to me closely. Every single one of you who is sitting there thinking that the day you retire is the day you stop worrying about the IRS, you need to wake up right now. You are making a mistake that could cost you tens of thousands of dollars, and it breaks my heart because it is entirely preventable. You have worked hard your entire life. You have sacrificed, you have saved, you have done everything you were supposed to do to build your nest egg. But if you do not understand the rules of the retirement tax game, you are going to hand over a massive chunk of your hard-earned wealth to Uncle Sam, completely by accident. Let's talk about the real problem here. When you are working, your tax life is simple. You get a W-2, taxes are taken out, and you move on. But the second you transition into retirement, you suddenly become the manager of your own income stream. You are pulling from traditional IRAs, 401ks, maybe a Roth, Social Security, and brokerage accounts. Every single one of those buckets is treated differently by the IRS. The fear that keeps so many of you up at night, the fear of running out of money, the fear of inflation eating away at your purchasing power, it is directly tied to how much you pay in taxes. If you blindly withdraw from your accounts without a plan, you risk pushing yourself into a higher tax bracket, triggering massive penalties, and quite literally destroying your financial security. The question you need to ask yourself right now is this: do I have a tax withdrawal strategy, or am I just guessing? Because guessing is not a plan. Let's break down exactly what you need to do, starting with the biggest shocker for most retirees, the taxation of your Social Security benefits. Too many people believe that Social Security is completely tax-free. It is not. The IRS uses a formula called combined income to determine how much of your benefit is taxed. If your combined income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefit, goes over just $25,000 for a single filer or $32,000 if you are married filing jointly, up to 50% of your Social Security becomes taxable. If it goes over $34,000 single or $44,000 married, up to 85% of your Social Security benefits can be hit with income tax. Think about those thresholds. They are incredibly low, and they have not been adjusted for inflation in decades. If you don't control your other income sources, you will accidentally trigger a tax on the very benefit you relied on to carry you through your golden years. So, what is the actionable takeaway to protect your Social Security and keep your tax bracket low? It is the beautiful, powerful tool known as the Roth IRA. You know how much I love the Roth, and this is exactly why. Every single dollar you withdraw from a Roth IRA or a Roth 401k in retirement is 100% tax-free. But here is the magic: because it is tax-free, it does not count toward that combined income formula for Social Security. It doesn't raise your adjusted gross income. If you need an extra $10,000 to take a family vacation or fix a roof, and you take it from a traditional IRA, you might push your Social Security into the 85% taxable bracket. If you take that same $10,000 from a Roth, your tax bill stays exactly where it is. If you are still working or recently retired and have a lower income year, you need to look into Roth conversions. Move money from your traditional, tax-deferred accounts into a Roth, pay the tax now while you know what the tax rates are, so that you can enjoy tax-free income for the rest of your life. Next, we have to talk about the ticking tax time bomb known as required minimum distributions, or RMDs. For years, you've been told to put money into traditional 401ks and IRAs because you get a tax deduction today. And that felt great. But remember, that money has never been taxed. The IRS has just been patiently waiting. Once you reach age 73 or 75, depending on the year you were born, the IRS steps in and says, "Time's up. You must start taking money out of these accounts, whether you need it or not, so we can finally get our cut." If your traditional accounts have grown significantly, these forced RMDs can be massive. They can completely distort your tax bracket, bump you into higher Medicare premium tiers, a hidden tax known as IRMA, and leave you with a massive bill you never saw coming. Your actionable strategy to fight back against RMDs, if you are charitably inclined, is the Qualified Charitable Distribution, or QCD. If you are 70 and a half or older, the law allows you to transfer up to $105,000 per year directly from your traditional IRA to a qualified charity. This money counts toward your required distribution, but it never shows up as income on your tax return. It completely bypasses your adjusted gross income. It is a win for the charity and a massive tax victory for you. If you aren't doing QCDs, you must master the art of tax bracket management. Do not just draw down one account until it's empty. You want to fill up the lower tax brackets by blending your withdrawals. Take a little from your traditional IRA to fill up the 10% or 12% bracket. Use your taxable brokerage accounts to capture 0% long-term capital gains rates if you qualify, and supplement the rest with your tax-free Roth money. You have to balance the buckets. I want you to take a deep breath and look at your financial life with total honesty. Fear comes from the unknown. When you don't know the rules, you feel powerless. But knowledge is power, and money is a tool to give you security. Do not let laziness or intimidation let the IRS take more than their fair share of what you spent 40 years building. Sit down with a certified tax professional, map out your withdrawal order, maximize your Roth accounts, and take control of your future today. You can do this, you deserve to do this, and you must do this. Stay safe, stay strong, and protect your wealth.